Hi guys, and welcome to the Smart Investor channel. On this video, we're going to review the best personal loans according to our research. We will review the pros and cons of each lender, understand what are the unique features of each loan, and learn how to pick up the right personal loan for your needs. Let's start. Personal loans are loans that are often sought after due to their versatility. Funds acquired through personal loans can be used for whatever the borrower needs. Often these funds are used for consolidating debts into one payment, planning for future needs, and an almost endless number of other things. These loans are often unsecured loans, which means their interest rates and other terms and conditions vary from case to case. The biggest factor in the variations is your credit score, the biggest problem in which loans are actually worth looking into. Just like the list of how funds can be used, the list of personal loan lenders is a long one. Now, you have to figure out which one is trustworthy and will help you, not hurt you. This is actually why we are here. We have gathered information of the best personal loans so that you can shorten your time hunting for the perfect loan that fits your needs. Here are the Smart Investor Select's picks for the top personal loans. 1. LightStream. LightStream is an online lender that offers very high loan amounts yet at low interest rates. LightStream is part of the Trust Bank Group, formerly the SunTrust Bank. You can use the loan for any purpose, including home improvements, debt consolidation, etc. LightStream does not charge fees, so there are no late payment fees, processing fees, or prepayment fees. Most of the loans have a term of 2 to 7 years, but this may be extended to 12 years for solar financing, home improvement loans, or swimming pool loans. 2. SoFi. The original idea of SoFi was to have school alumni invest funds in refinancing recently graduated students' debt. SoFi has moved away from that business model and moved to a non-traditional underwriting approach, focused on lending to financially responsible individuals. SoFi uses an underwriting model that examines free cash flow, professional history, and education in addition to a history of responsible bill payment to evaluate its borrowers. SoFi offers plenty of benefits for those who qualify for a personal loan. They also have some of the highest credit and cash flow standards. Also, SoFi offers professionals many benefits and tools that can help them become more financially independent. 3. Marcus. Marcus is an online-only lender offered by Goldman Sachs. It offers personal loans with no fees, including late fees, prepayment fees, or sign-up fees. Since you're only required to pay the principal loan sum and interest, the interest rates are a little higher than the competition. However, this can be a good option for those with a good credit score who want to avoid annoying fees. Where Marcus personal loans are a little different is that there is the option of pre-qualification. If you're not sure if you will be eligible for a loan, you can complete a basic short form. This only involves a soft check, so you can avoid triggering a hard credit check and potentially compromising your credit score. Pre-qualification will allow you to check and compare your Marcus loan options. 4. Prosper. Prosper is the first peer-to-peer lending marketplace, established in 2006 in San Francisco with $13 billion in loans. Peer-to-peer lending is a platform that matches lenders with borrowers. Prosper Marketplace is a great place to start in your personal loan search. Prosper focuses on the mass market of borrowers, and their personal loans can be used for a wide range of reasons. They also have a lending arm for medical costs, Prosper Healthcare Lending. They offer personal loans for a wide variety of purposes and to a large market of borrowers. They do have a high origination fee, while other providers do not have one. The process will take longer than with other platforms, so if you need funds quickly, Prosper may not be the right place to start your search. 5. Discover. Discover offers a variety of products including personal loans with competitive rates and no origination fees. You can use a Discover personal loan for various reasons, from financing a large purpose, such as home repairs or a wedding, to debt consolidation. You can also use your personal loan to cover unexpected expenses, remodeling your home, or purchasing a new vehicle. If you want to use a Discover loan for debt consolidation, Discover will send funds directly to your creditors. You'll need to use at least 70% of your loan for your existing creditors, or your final APR may be impacted. Now, besides reviewing the top lenders, it's important to understand how to make the smartest choice for your needs. What can I use a personal loan for? A personal loan can be used for just about any purpose. The most popular reasons people take out these types of loans are for debt consolidation, medical bills and expenses, weddings, vacations, home improvement projects, and even refinancing an already existing loan. The best way to use them would be to reach your financial goals instead of impulsively. A personal loan should only be used when it makes your goals easier to reach. For instance, home improvement projects make your house worth more. Additionally, consolidating your debt under a lower interest rate would help you pay it off faster. No matter what you choose, you will want to use it well. The best options are large expenses, whether they be planned or a surprise. You will need to be certain taking out the loan will not harm you financially in the future. How to get a personal loan. Before you take out a personal loan, be sure you are able to follow these steps. Determine how much you need to borrow. Review your credit score. Find a good lender. Check your eligibility and get pre-qualified. Review the loan details. 1. Determine how much you need. Remember, when taking out a loan, you will need to pay back more. You are going to be paying interest and possibly a fee to get the money. You do not want to pay on funds you do not need, so only take out what is absolutely necessary. Additionally, you will want to know you can afford the payments that come later. There is no reason to put yourself into debt if you can help it. 2. Review your credit score. There are some websites that offer a free credit score report. You can get one a year from the biggest brands such as TransUnion, Experian, Credit Karma, and Equifax. Some student loan sources report your credit score a few times a year as well, such as Sallie Mae. The higher your score, the better APR and loan amount you will receive. If your score is 760 or more, you will have the best options. 3. Find a reliable lender. Credit unions and banks are the best places to go for a personal loan. If they have a banking license and operate under the FDIC, you can be sure they are reliable. You will want to go to those options first and stay away from payday loans. 4. Check eligibility and get pre-qualified. You can call or visit potential lenders to find out if you are eligible for a loan with them. If you are, you can be pre-approved. It does not mean you will get the funds for sure, but it helps. You will be asked to fill out a form with your information. 5. Review loan details. Finally, go over the details in the loan. You will want to be familiar with the APR, monthly payments, the loan term, and if there are fees or penalties for late payments. Lenders must legally give you this information. When you shouldn't get a personal loan. First of all, if you do not need the funds for a good reason, it is usually not advisable to get a personal loan. It is usually not a good idea to get a personal loan to pay for a vacation or a luxury purchase. It should only be used for important reasons like paying medical expenses or buying a car. If you do not have good credit, it can often be a bad idea to get a personal loan. This is because you already don't have a good record of dealing with credit, and you may end up worsening your score even more. How to compare personal loans. If you have decided to get out a personal loan, you will need to take the next steps to determine which one is right for you. You will need to start by comparing rates from various lenders. These are the factors in a personal loan you will want to compare: APR, loan term, monthly payments. Overall, the loan with the lowest APR is going to cost the least in the long run, making it a better option most of the time. APR. APR is the interest you will need to pay back on the loan. That interest amount will be added to your monthly payments to the lender. They will use a formula to figure out how much interest you owe on your loan, which is the APR divided by 365, the amount of days in a year, to find your daily periodic rate, DPR. Then the DPR is multiplied by the days in a billing period, and again multiplied with your current loan balance. The final result is the interest charged. Because of this, every loan that is taken out will cost a different amount to pay back. Plus, the faster you pay it back, the less interest charged to you in the long run. Loan terms. The loan term is the amount of time you will be making the payments. When it comes down to it, a longer term means lower monthly payments, but also causes you to pay more back in interest. You will want to consider how the monthly payments fit into your budget and what is possible for you to spend. Additionally, the loan term can be impacted by the repayment method. For example, signing up for automatic payments with your lender may give you a reduced interest rate or term as a reward. You will want to ask your lender about any benefits they might be able to offer you. Monthly payments. When comparing personal loan options, make sure you are comparing the monthly payments. That way, you can determine which option will fit into your budget later. You do not want to cause yourself financial hardships, so be sure to carefully examine the monthly payments from each potential lender. Some lenders can even offer you a flexible payment plan, which allows you to alter the payment due dates. They may have more features available. Your lender will be required to give you a lot of this information, including APR. From there, you should be able to determine what your payments are going to look like. Figure out the amount for each lender you are looking at. The potential risks of a personal loan. However, there are some risks of personal loans that you will need to be aware of. It can be nice to make a large purchase right away, but you will need to pay back that amount. When you cannot, you might ruin your credit score, among other things. Hurting your credit. If you miss your payments often, your credit score could be impacted. Even one late payment can cause your score to lose 100 points, taking a very good score to fair overnight. If you wait longer to make the payment, your score is going to be damaged even further. It can take a very long time to rebuild your credit score, so you will want to be sure you can make the payments on time. Fees. Some loans come with many fees. For instance, the origination fees we mentioned above. They typically will make up 1 to 8% of your total loan amount, which can be a lot depending on circumstance. However, while rare, you will also want to keep an eye out for prepayment fees. These are fees that are charged when you pay off your loan too early. If you are unaware of this fee, it can be a major surprise to be charged extra money for doing something good. Personal loan mistakes you should avoid. There are many potential mistakes that you might make if you are borrowing for the first time. These are the mistakes you will need to avoid. Not knowing your credit score. It is crucial that you know your credit score before you apply for a personal loan. You want to get the best terms, but cannot unless you know it is good. Not comparing options. You will always want to compare your options. Something better for you might be out there. You can find loans with lower APRs and different lending terms. When you go with the first loan you can find, it is not likely to be a good one. Making late payments. On-time payments improve your credit, but late payments can greatly harm your score. Plus, you might also be required to pay late fees. You can avoid this by going with automatic payments or setting reminders for each month in your phone for a few days before it is due. Not reading details in the contract. People have a habit of signing things they have not read. Never do this with a loan. You might be agreeing to impossible terms. Your lender is required to disclose all information about the terms of the loan, so you will want to ask if you're not understanding something. Not considering APR and your term. The APR includes your interest rate fees and other charges which add into the cost of the loan. Additionally, your loan term will impact your monthly payment and how long it takes to pay back the debt. That's it for now. Thank you for watching. On our website, you can find side-by-side credit card comparisons, extensive reviews, and full guides that can help you maximize your credit card rewards or build credit responsibly. What is your favorite personal loan lender? We would love to know your thoughts, so feel free to share them in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos as soon as they go live.